needs to be expensed this accounting period only. So it will be spreaded over the, depending on, I mean, how, I mean, based on the matching principle, how long it is going to match with the revenue, right? So that is what is discussed here, that cash investment and the return from the cash, that is we get from a multi-period. It is a multi-period setting. So there is a no predetermined end to a firm's life, and cash invested and generated at multiple points in time. So the difference between the income statement and cash flow statement is, whenever cash flow statement shows that when you are investing and when you are getting the return in a particular period. But in case of the financial income statement, it means that for a particular accounting period, even if cash flow happens or not, whether this revenue or expenses are meant for that accounting period, that only is considered. So that is the main difference between these two accounting, cash based accounting and accrual accounting. Okay, so when we talk about statement, income statement, so that income statement may be a quarterly statement, it may be an annual statement. Okay, so artificially divide the life of an organization into annual periods for the purpose of financial reporting. So if you are dividing it in year basis, on year basis, so that means it is an annual accounting, annual reporting you are making, what you get in the annual report of the companies. You will also find the quarterly income statement, quarterly reportings, quarter to quarter, I mean, analysis that we get in every quarter. The companies, they disclose their I mean, performance status, and that is compared with the last year's particular that quarter's status, and that way, I mean, we analyze the company. So it may be quarterly, annual, whatever, but that accounting period is concept is necessary, because that matching principle, that also applies if even if you are preparing the quarterly reporting. In that case, for next quarter's expense, you are paying it an advance. So that means it will not go to your, even if it is the same accounting year, but it will not go to your expense in income statement, but it is a prepaid advance payment made, so it will go to your current asset. Okay, so I think these terms are now more or less clear to you. So why is there a demand for periodic performance measures? One, as I said, that to understand the performance trend, to get the valuation of the company. So how you are going to value the company based on the performance of the company, right? So you need to know the trend, and then only you can anticipate or assume what are the future trend will be. Based on that future, you are going to value your company, right? So that valuation purpose, this periodic performance is necessary. Otherwise, how you are going to calculate that how the company is performing? You need to have some kind of parameter. And next is to evaluate management performance. So who is making the company performed? The management, right? So to have a monitoring on the management, to evaluate the performance of the management, again, you need to have some kind of parameter. Based on that, if the company does well, you reward the management and decide whether to continue to trust the firm's asset with the current management. Now, how we do that, that we will discuss later on. So financial accounting information must be verifiable and reliable, and conservatism, this particular concept also we discussed. Asymmetry in the treatment of gains and losses, greater degree of verification. So when we treat the gains and when we consider something as loss, the conservatism principle actually emphasize more on the loss, on the gain part. That means the gain part, they will not explain that, they will try to not show more the gains, but whatever may be the loss, they will try to disclose it. So greater degree of verification for gains than for losses, and required by GAAP, but arose voluntarily. Why? Because there will always be the management's incentive to report good information and hide bad information. Why? Because maybe the management, depending on the performance of the company, maybe they will be incentivized, right? They will get the bonus, and other things also will be, they will get, depending on whatever they will show, they will have the incentive to show that. So they may hide. So if there is no conservatism principle exists, just like the reserve for bad debt, they can something show that yes, this is a my anticipated revenue, anticipated sales. So that needs not to be, that needs to be checked. So for that, that conservatism principle. Okay. And credibility of information in valuation. So I will give you few examples. You can read it on your own. I'm not going to explain it here in the class because that will take time. So you will find that some say for example, some kind of companies are there which is a I mean project based earnings. That means a long project, and the realization of the revenues, it does not happen at a time. Okay. So the getting the to the customers to get the to realize the value from that project, it is not a one time event. So how you are going to recognize the revenue from that particular project? It may happen that there is a timeline, or there is certain I mean certain benchmarks are there that you, if you reach that particular landmark, then only I mean you will recognize as a partial recognition of revenue. So if you do this part of job, then you are going to recognize that you are getting the payment, and you are going to recognize that as your revenue. Another part of job in that particular project, when which will be done after that, you will recognize it as your revenue. So it is a partial recognition of revenue. Now think about it. I mean, how you are going to decide that at what point of time what you are going to recognize as revenue? There is always a chance of discretion, application of your discretion, right? So it varies from the company to company that how they are going to recognize that partial recognition. So this depends on the individual company's policy, which is under the purview of your regulations, but still there is a scope of applying the discretion. So here there are that you can, I mean somebody can, as I also explained to you about the deferred revenue expenditures, the advertising expenditures, the depreciation expenses, how we can, different companies can just treat the amount of expense differently, the life, depending on the lifetime of the particular life period of the particular asset, they can decide that how much to depreciate. Similarly, at what point of time you are going to recognize the revenue, that will determine that in a particular accounting period what will be your revenue, right? And that will determine your profit. So there are scopes of applying discretion. So conservatism principle actually have some kind of checks on that. Then next comes, there may be there is another kind of example that I can give you. There are some bill and hold policy. So for example, you are going to sell the product, you have sold the product, but your customer does not require it right now, does not require it right now. So what they are saying is a bill and hold. So billing is done, but you hold. The seller is holding because the customer, if they take the, say for example, a winter garment. Okay, so right now it's a cyclical kind of demand. So in winter season only that demand arises. So what you do, you are getting at a huge a retail shops, maybe from a wholesaler, he is getting it at a discount. So maybe in the summertime only, the whole product is built, the order is built, okay, but you are not taking the um, sales. I mean, taking the your product, and you are keeping it with the seller only. Why? Because if you consider to have it now, then you need to bear the warehouse cost and others, the storage cost. So you are not going to take that bear that cost. So you are keeping it with your seller only. Okay, but the billing is done. Now at what point of time you are going to recognize it as your revenue? That is the, those are the, question comes, right? So these are the different kinds of policies, and depending on that, the revenues and its impact on profit, everything gets changed. And there are the few things, few places where there is a scope of application of your discretion. And depending on that only, you will find that your revenue, profit, these things vary. So the suggestion to you is, when you see the numbers, you need to also check that what is the kind of product or service the company is providing, how it is actually measuring the revenue. What is it? It's revenue recognition policy. So these are the behind stories that you need to understand when you are going to interpret. It is not blindly just to follow the numbers and to take the numbers as a revenue. This is the top line, this is the bottom line, and so the company is doing well or doing bad. Okay, so what are the stories behind it? So there's every chance that management can make, I'm not using the strong word manipulation, but still there can be tweaking the numbers. It can be done. Okay, so as a learned accounting person, you should understand the behind the underlying story. Okay, and the conservatism principle tries to check all those anticipated gains, but it shows it you have to disclose all the anticipated losses. So who actually verifies it for you? The auditors, right? So that's why the demand for the auditing service and the demand for the, I mean, reputed auditors are so high. So do you have any idea about who are the auditors? The chartered accountants, right? So who are the big audit firms, the big four, big five audit firms? Any idea? Anyone? Hello?
Yes,
Ma'am, I
ma'am.
think
Deloitte,
something like
EY,
Yes, yes, yes.
Ernst
Just,
and
just
Young, Deloitte,
yes, yes, yes,
PwC, and
yes.
KPMG,
True, true. So PwC is the Price
and
Waterhouse Coopers.
KPMG.
Okay, yeah, KPMG. So those are the big four auditors. So I mean, this auditing, and if you find that over the period, over the years, the regulations for assuring the fair and transparent view of the disclosures, it has become more and more stringent, but still we are far behind than the western countries. But I mean the, and even if there are regulations, there is always a scope of, i mean uh, changing the numbers. Okay. Okay, now we know that the revenues and expenses are the two most important components in the income statement, right? What else? You will find that revenues and gains and expenses and losses. Okay, so these terms are considered in our income statement. So it is not only revenue, not only expenses. So what do we mean by gains and losses? Here it is mentioned selling an equipment for cash greater than its net book value. So now somebody, can you explain that why gains is not revenue? It is also selling an equipment for cash greater than its book value. So why it is not revenue? Who wants to answer? Please raise your hand, okay? Yeah, Saurav, what is the difference
ma'am,
between revenue and gain?
ma'am, because the selling of an equipment does not
Mm-hmm.
come under the recurring operations of the firm. Like it does
Yeah, so
not come under the
true, true,
expenses.
exactly, absolutely. So it is not the operation of the farm. So it is, if it is an equipment manufacturer, then it is an operation. But since it is assumed that it is not an equipment manufacturer, right? So this equipment is a asset to him, asset to that particular farm. So that's why selling of equipment will not come under the revenue. Revenue means the operating revenue. Okay, the operations, the revenue generated from your business operations, the product or service you are dealing with. So what is the what will be the, so who was answering? Saurav, right? So Saurav, can you
Yes, ma'am.
tell me, say for example, you are selling you are selling goods at 10,000. Okay, and you have sold, so what will be at and the cost of good is cost of goods sold is say 7,000. So what will you consider as revenue in your income statement?
Revenue will be 10,000.
10,000. Now you have sold equipment at 10,000. The cost of that particular equipment is 7,000. So what you are going to consider in the income statement?
We will consider as ma'am 10,000. Can you repeat 10,000 is?
Again, 10,000 is the sales value and 7,000 is the cost price. Just like
Okay.
you're the selling goods, right?
1000
So
days.
now it is selling equipment. So what you are going to consider in your income statement?
Then it will be put as gain of 3000.
3000 gain. So there is a difference, right?
Yes, ma'am.
Where is the difference? Actually, there is not a difference. When we are considering the goods, that is the I mean, our operations, which is we are dealing with the, I mean, our operations is dealing with that particular goods. So there in revenue, as revenue, we record the whole 10,000, and the 7,000 we record as cost of goods sold. So actually what you are recording, we're recording that particular margin, that gain 10,000 and 7,000, but you are recording it two accounts. One is the revenue, one is cost of goods sold. But in case of your equipments or assets, it is not that you can record it as revenue and then again it is cost of goods sold. So it is neither revenue nor cost of goods sold. So we are only recording the difference between these two. That is a gain out of it. Okay, 10,000 minus, because why? Because it is an asset to that farm. It is not the goods to that farm. That is the difference. Okay, so actually we are doing the same thing here, the revenue and cost of goods sold, and here only the um, difference that we are recording. Okay. Um, so it is a kind of one-time gains and one-time loss. It is not that um, recurring, as sort of rightly pointed out, it's not a generating from the recurring operations. Okay, so it is one time. And what are other revenues and expenses? Interest revenue, dividend income, interest expense for a manufacturing and merchandising firm. So what is interest expense we can understand, right? Why it is especially manufacturing and merchandising firm it is mentioned. Now who can explain that? First of all, interest revenue, dividend income, what are those? Why they are considered as other revenues and expenses? And why it is mentioned that interest expense for a manufacturing firm, and why those are put as other revenue and expenses? Who wants to explain? Saurabh, you have answered once. Anyone else? Divyam, you raised your hand few minutes back. You want to answer, Divyam?
Yes, ma'am.
Yeah, so just explain.
Ma'am, these are also not coming from our core business,
Yes.
but we might have invested our previous earnings in
Yes,
some
yes.
stocks, and that we are getting back as dividends.
Yes. So what
And
is interest revenue, Divyam? Just be clear, because I mean these are very simple, but still who are new, I mean in this accounts, who are doing it first time. So for them it is sometimes it is confusing. So if you can please explain. What do you mean interest revenue?
we might be getting
Uh-huh.
interest on
For
our
what?
some capital that we have already invested. Let's say we have bought some, or we might have some cash sitting in our savings account, and we could get the interest out of it.
So that
And
means interest means what? When interest becomes your revenue, when you are giving cash to somebody else, right? So you are
yes,
giving, company is
yes,
giving loan to others. So it is a
yes,
debt instrument where you are making the investment. Yeah, that is the difference. When we say interest and when we say dividend income, just point out the difference. Dividend income means you have invested. Both are cash outflow, and on the on that cash outflow you are earning something. So the interest revenue means you have invested in some debt instruments.
yes,
Okay,
ma'am.
and you are getting, you have invested. It is not that you have taken the loan, you have given someone, you have invested in some debt instruments and you are getting, you are earning the interest on it. And dividend income means you have invested in some equity instruments, right? So you
Yes,
have invested in some other shares and you are earning the dividend out of it. So as you rightly said, that these are not from our core business. These earnings are not from our core business. Now, why it is mentioned that interest expense for a manufacturing firm? Then only it is other revenues or expenses, otherwise not. Why so? Yes, Saurav? When
Ma'am,
it is
for
not an, yes,
banking firm or that
yes.
finance, the
So,
interest.
so Yes, so for banking firms, this interest actually is not so for if is not a kind of, I mean, it is for from their operations only. For manufacturing firms, it is not from for their operations. So you will find that there are other incomes and other expenses in the income statement. So that means what do we, why we are putting the other term here? This is not generated from the operations. That's why. Okay. So the income statement measures farm performance regardless of when cash is exchanged. Toward this end, two key principles are, as I discussed. One is revenue recognition, earning process substantially complete, cash collection reasonably assured. So these two things only are mentioned. Maybe this is your guideline. So now what is substantial and what is reasonable, that is as per your discretion. That is as per the company's policy, and that's why the company to company it varies. So when we make the similar companies analysis between two similar companies who have the same operations, so we need to also check what is their revenue recognition principle. You will get it in the footnotes. Okay, notes to accounts will get it, that how they have recognized the revenue. Okay, so then only you can compare it very properly. But both the cases, conservatism principle is applicable. So you are anticipating that you are going to this order is going to be converted into sales. The sale is going to, I mean, the converted into collection, or the, I mean, the shipping is it is already shipped, or it is in the transit, or it has reached, or whatever it is. When you are going to recognize it, whether it's substantially it is complete is there or not, conservatism principle actually guides you on that. That you should not record your revenue based on some assumptions or anticipations. Now the matching principle for expenses, these also are discussed. Match efforts to the benefits generated, capitalize expenditures that will benefit future periods, expense as benefits are realized. This is, I explained many a times, but still these terms are new to many of you. So anyone who wants to explain that, what do we mean by capitalize expenditure and expense as benefits are realized? Yes. Again, Saurav, anyone else? See, I mean, attempting to answer is always, I mean, good, rather than, I mean, yes, Mohit, you explain. Because as I said, it is, I mean, correct answer I do not want, but either you are understanding or not, that is, I need to know that. And if only few people are going to, I'm recording the responses, only few people only are responding in the class, then I need to go to for individual evaluation. It is not possible, right? So try at least to answer. Yes, what do we mean by
In the,
capitalize? Mohit, you answer.
yes, in last assignment, you have given example that
Yes. No,
transporting
what do we
the
mean by that capitalize expenditure, that particular term? Just mention that. I mean, just tell
uh,
me that capitalize expenditure.
whatever expenses we have occurred on purchasing capital assets, we can either we can keep it in as capital asset,
Mhm.
or we can expense it from the income statement.
Yes.
uh,
So capitalize expenditure. So you know that capex means capital expenditure. What do we mean by capital expenditure? What is it in the balance sheet? What is it called?
expenses
In
for
the balance sheet. In the balance
acquiring
sheet.
assets.
No, no. Capital expenditure. What is the other term of capital expenditure?
Not sure.
Okay, job. Yes.
Ma'am, OPEX, operating expenditure.
No, no, capital expenditure I'm asking. What is the other name of capital expenditure? What we say very commonly in the
Investment.
balance
Capex.
sheet? Yeah, capex. What is the other term of it? Capex is what in balance sheet?
Fixed
Where it
assets.
comes? Fixed assets, yes, that is what I was wanting. Okay, the fixed assets. So as the fixed asset is your capex. So that's why when you are going to consider some expenses, so that means the expenses, the nature is not capex, neither it is opex or revenue expenditure, right? So capitalized expenditure that will benefit future period. So that means you are making it, you are capitalizing this expenditure. The example I have given is the your advertising, right? So you make it R&D, you capitalize that expenditure because it is going to benefit the future period. Then expense as benefits are realized, so take it out a particular value and then you put it in your income statement where you think it is going to help to generate the revenue for that accounting period. That amount only you take it out from that capitalized expenditure and you consider it as expense in your income statement. Okay, now recognize liabilities when efforts benefiting the current period require cash payment in the future, like outstanding wages, for example, outstanding salary. Recognize the liabilities when efforts benefiting the current period require cash payment in the future. Oh no, it is liability. Yeah, so you recognize it as your liability. You are getting the service now, but you are going to pay later. Produces a difference between cash flows and earnings. So this way, this matching principle actually making the difference between the cash flow and the earnings. So here one example that I have discussed only, that is, let me go to the slide. So just read it. The same example I have discussed in the class. A company spent 20 million on advertisement on the launch of its new shampoo. The company estimates the life cycle of the product 2 years. The first year, the estimated sales is 50 million and the second year, 17 million units. So this 20 million, how much should A&M company recognize as an expense each year? So if you go by the ratio, the proportion, that since the sales it is going to generate 50 million in first year and 17 million in second year, and you are going to apportion your advertising expense on the basis of that only, that particular proportion. So you just make the ratio and then you treat your expense like this. So first year 15 out of the 20, first year you consider 15 as your expense and 5 will remain as your asset. And the next year the asset will be 0 and that 5 you will treat as your advertising expense. Okay. Um, Now, if you decide, the company decides that it is not 15 or 5, we are going to divide it over 3 years. It is going to generate the revenue for 3 years, and 50% will be the first year generation, and second year and third year 25, 25. So the same expense, see, you are distributing over 3 years, 10, 5, and 5. So what is how you are going to record it here? So your cash outlay, um, initially it is only 20. You have recognized the asset the whole 20. The sales you are making 150 in the first year, your retained earnings at the beginning it is 150, and at the end of the year, when you are given everything constant, the 15 you are considering, um, how much we're considering for the first estimate. One is 15 and 5, and for the second estimate it is 10, 5, 5. So if we go by the first estimate, so for the first year we are deducting out of the 20 in the asset, we are deducting 15 and we are taking it in the income statement, which is reducing our retained earnings. And the second year we are deducting 5, the rest 5 from the asset, and we are taking it in the income statement, and which is reducing our retained earnings again by 5, end of year 2. But the total advertising expenses total is 20 million, taking 2 years into consideration. And if you go by the estimate 2, so end of year 1, it is, earlier we were deducting 15, now we are deducting 10 from the asset, and we are considering that 10 in the expense side. Then year 2, the 5 we are considering in our, we are reducing from asset and we are considering as expense, and it is reducing our retained earnings. And year 3 again, 5 deducting from asset and 5 recognizing as expense. So total expenditure, advertising expenses remain the same, 2020. But see how the Earnings. Earnings means what? Income. Income means what? Profit. Again, don't get confused with those terms. So, however, earnings, just because of treatment of the advertising expense differently, how the earnings vary. Okay. Okay. Now, one thing I think needs to be discussed, but I have not discussed it elaborately in the class. I mean, I just touched this particular example. So let us also understand that how we record the cost of goods sold, where from it comes. So company A buys 10,000 worth of cereals from Special Foods for cash. Okay, understood? So your cash is reduced by 10,000 and inventory you are recognizing on 10,000. So your asset side cash decreases, asset increases, and the equation is matching. Exchange of one asset for another and your cash outflow is rupees 10,000. Now company A sold one half of those cereals for rupees 8,000 cash. Okay. Uh, so now can you tell me, I mean, in this example, I think I have discussed, but not the whole transaction I have discussed. A part of it I have discussed. So can you tell me, I mean, it is, you have already done. So what is the treatment in the accounting equation? What will be the effect? When you are selling these 8,000, one half of the cereals. So what is the cereals? It is 10,000 worth of cereals and one half of the cereals you are selling in cash, 8,000. So what will be the, I mean, on just based on these particular transaction, 8,000 cereals sold in cash, what is the effect in the accounting equation? Shreyash, yes, Shreyash?
Hello, ma'am. Yeah.
Yes, Shreyash.
So ma'am, the 8,000 first the cash will increase, but on
Hmm.
the other side the expense, the cost of goods sold, which its market value. I mean the
Hmm.
cost will be recorded as expense,
Hmm.
cost of goods sold, and the gain will be the extra cash that we get. So we can
No,
divide.
no, no. I mean, how the equation, as you said that cash will increase by 8,000, right?
Yes, ma'am.
So then,
Uh,
hmm.
and the cost of goods sold will be recorded as expense, uh, and
What will be the amount? I mean, try to match the equation. So 8,000 will be in your asset side. Increase in assets,
yes,
8,000. Then
uh,
where will be the, I mean, the 8,000 also you should put somewhere else, right? Otherwise, how it is going to match?
yes, ma'am.
So where
So
you will put that 8,000? One side is the cash in asset side. The other side?
on the other side, eh, now I'm confused.
Okay. Anyone else? Ritik, you please answer.
Yes, ma'am.
Hmm.
Ma'am, the
Just that 8,000, tell me.
yes, ma'am. Like
Hmm.
when we are getting 8,000 rupees in cash in the
Mm-hmm.
asset side, it is
Hmm.
increasing. Similarly, we can say on the owner's equity, we are getting a revenue of 8,000 rupees. So
Good. So
in
that means
total, owners is
8,000. Yeah. So that means the equation, how it is affecting the equation is matching or not? It is matching because asset is increasing by 8,000. Cash inflow has happened. And at the same time, we are recognizing it as our revenue. So forget about the, Shreyash, forget about the cost of goods sold for the time being. So I'm asking about this treatment of this particular 8,000. So one is the cash inflow of 8,000 and the same is reflected in the income revenue side of the income statement, that is 8,000. 8,000 increase in revenue means 8,000 increase in profit, means 8,000 increase in retained earnings, means 8,000 increase in equity. So asset increasing by 8,000 and equity is increasing by 8,000. So it is matching, right? Now then you try to answer about the, cost of goods sold part. Okay. So Ritik, you want to continue? No?
Yes, ma'am.
Okay. Okay,
Cost
Ritik.
of
Yeah. Hmm.
yes, ma'am.
Hmm.
Like I'm thinking on that. No problem.
Yeah.
Maybe someone else.
Yeah. Hmm. So here the most significant matching expense. So here the asset and the equity is matching. Okay, the 8,000 and 8,000. What is the matching expense here? Remember, you are selling one half of the inventory. So it is not the entire 10,000 is going to be your expense, right? One half only you are selling. So now how you are going to treat it? The cost to company A buying the cereal that was sold for rupees 8,000. So that is the matching expense. So if 8,000 is your revenue, what is the, by selling what you have, you have earned this revenue by selling one half of the cereal. That is 5,000, right? So then tell me, what is the cost of goods sold? It is simple, right? What is the cost of goods sold? Anyone can tell me. What is the cost of goods sold? What?
5,000.
I'm 5,000.
5,000. Okay, 5,000. So based on this transaction, one equation you have made is uh, 8,000 asset increase, 8,000 revenue increase. Now the question is coming about the recognition of expense. So as you rightly said, 5,000 is your expense, cost of goods sold. So where it will go in accounting equation? So if it is 5,000 you are considering as expense, so expense goes where? Simple, just tell me. Expense goes where? Which side of the equation?
On the right side.
Right side, which side? I mean, what is the under what I
Equity
equity, right? So
interest.
expense is you are considering as 5,000 as decrease in equity, right? 5,000 expense means decrease in profit by 5,000, decrease in retained earnings by 5,000, decrease in your equity by 5,000. So decrease in equity 5,000. So where the other part will go? Other effect. What is the other account? See, the other account is your
Asset account.
Ma'am,
asset
asset.
account. Yes. So asset account means the asset will no more. I mean, you just remember that in this here, when you have purchased the 10,000, the inventory is showing 10,000. Now you have sold 5,000 of it. So what will be the remaining part? The 5,000 only. So you need to deduct this 5,000 from this inventory. So in your balance sheet, you are going to deduct this 5,000. So what is the treatment of 8,000? 8,000 asset increase, that is cash increase, and 8,000 revenue increase, that means equity increase. And what is the treatment of 5,000? 5,000 is your expense increase, that means equity decrease, and 5,000 your inventory decrease, that means asset decrease. See, that will also match. Okay. So two transactions actually are combined here. Actually, these are two transactions. So there are 8,000, 8,000 and 5,000, 5,000. And this 5,000, the part that you are using it for selling, that 5,000 is only your cost of goods sold. Because you are following an accounting period, the entire 10,000 will not be considered as your expense or cost of goods sold in that particular accounting period. It will stay as inventory in your balance sheet. Only the part that is you are consuming, you are selling, that part will be considered as your inventory, and that part only will be considered as cost of goods sold in your income statement for generation of 8,000 revenue. So that is what is a cost of goods sold. Don't get confused at all. Just try to understand what are the accounts it is affecting and whether your equation is matching or not. Okay. So what is the gross profit or margin? So this difference between your revenue and your this just right side of the equation, just look at it. 8,000 is plus retained earnings and my negative is 5,000. So this difference is your margin. So when I discussed about that gains of sale from equipment, that was the 3,000, right? So there we only considered that 3,000 as gain from sale of equipment. But here we are first putting it as revenue and then putting it as cost of goods sold. And the difference is our margin. This is called gross margin or gross profit. Okay. Sales revenue minus cost of goods sold. So this is your gross margin. So this is all about the components of income statement, and each and every when we do the financial statement analysis, we will understand that each and every component of the income statement matters, because the higher the gross margin, the higher you can afford to bear the operating expenses. You can think of spending more on advertisement. You can think of spending more on R&D. You can think of spending some higher, you can higher skilled employees with higher salary. So if your gross margin is not high, you cannot afford to have those, which is ultimately going to impact on your revenue. If your gross margin, so what will be your target first? To improve your gross margin. And how can you improve that? Either by increasing the price, or by increasing the volume of sales, or by the reducing the cost of goods sold, that means manufacturing cost or cost of sales, whatever it is, the direct cost that is related to the product. And once you are able to make a high gross margin, then only those administrative expenses, those marketing expenses, those are, kind of fixed expenses, periodical expenses. So you can think of bearing a higher operating expenses, which is ultimately going to impact your revenue. Okay, you can go for you can think of a bigger, office, or you can think of increasing your capacity. You can go for a different locations and bear some higher cost on your infrastructure, regular infrastructure cost. Okay, so those are the kind of things that you can only think when your gross margin is good, right? Okay, so it is already 11. I have lost few minutes in at the beginning, so I couldn't complete it. Tomorrow I will complete, and tomorrow I think that we can have a good discussion with good case discussion. If possible, I will upload the case today only. Huh? So you just read the case and then come to the class. Let me just take the attendance. Yeah, so I've taken the attendance. You may leave now. Okay.
Thank you, ma'am.
Thank you, ma'am.
Yes, and as I mentioned, that your exam will be in the next week, next Wednesday. And tomorrow and day after tomorrow will be regular class.